Hello everyone and welcome to this lecture on ISA 320 Materiality in Planning and Performing an Audit. Materiality is one of the most fundamental concepts in auditing. You will hear this word often because it guides auditors in deciding what is important, what needs attention, and what can be ignored. In this lecture, we will unpack what materiality means, why it is critical in planning and performing an audit, how auditors determine it, and how it may change during the audit. This standard deals with the auditor's responsibility to apply materiality during an audit. It focuses on two stages. Number one is planning the audit. During planning the audit, setting materiality to guide audit procedures, and during performance of the audit, applying materiality when evaluating errors or misstatements. There is also a companion standard ISA 450 which deals with evaluating misstatements, but ISA 320 lays the foundation. Now, what does materiality mean? Financial reporting frameworks usually describe it in this way. A misstatement, including an omission, is material if it could reasonably be expected to influence the economic decisions of users based on the financial statements. Three important points flow from this definition. Judgment is key, like deciding materiality depends on context. Sometimes size matters most, sometimes the nature of the item. And number two is users as a group, where materiality considers the needs of common users, not individual shareholders or creditors with unique concerns. And number three, size and nature. Both the magnitude of a misstatement and its nature are relevant. For example, if a company with 10 million in sales misstates 100,000, that might not be material. But if the 100,000 relates to undisclosed related party transactions, it could still be material due to its nature. The objective is simple: to ensure the auditor applies materiality appropriately when planning and performing the audit. This way, the auditor can focus resources where misstatements are most likely to affect users' decisions. There are two terms you must remember: overall materiality and performance materiality. The overall materiality is the threshold used to assess the significance of misstatements in the financial statements as a whole, while performance materiality is a lower amount set by the auditor to reduce the risk that undetected and uncorrected misstatements in total exceed overall materiality. Think of performance materiality as a safety margin. Determining materiality. When planning the audit, the auditor must determine materiality for the financial statements as a whole. This is usually based on a benchmark like profit before tax, revenue, or total assets. The choice of benchmark depends on the type of entity and what users care about. Materiality for specific classes of transactions or disclosures. Sometimes smaller misstatements in certain areas could influence users. For example, management remuneration, related party transactions, or sensitive disclosures may have a lower threshold. And also performance materiality. This is set at a lower level than overall materiality. Why? Because many small errors can add up. Performance materiality reduces the risk that small undetected errors collectively become material. Auditors use professional judgment and often apply percentages to benchmarks. Examples include are like 5% of profit before tax for profit-oriented entities and 1% of revenue or expenses for not-for-profit entities, and total equity or net assets in special cases. The benchmark chosen reflects what users focus on most. Materiality is linked directly to the audit risk. Audit risk is the risk that the auditor expresses an inappropriate opinion when the financial statements are materially misstated. By setting materiality carefully, the auditor balances efficiency and effectiveness, focusing on what truly matters. Materiality is not fixed forever. If new information comes to light, for example, if actual results differ greatly from expectations, the auditor must revise materiality and adjust audit procedures accordingly. Finally, auditors must document the materiality for the financial statements as a whole and any specific materiality levels for classes of transactions or disclosures. Also, the performance materiality and any revisions during the audit. This ensures transparency and audit quality. To sum up, materiality is about what matters to users of financial statements. It guides auditors in planning procedures, testing evidence, and evaluating misstatements. Remember the hierarchy: materiality for the financial statements as a whole, then specific materiality for sensitive areas, and performance materiality as a safety margin. So, if ISA 315 taught us to understand the entity and identify risk, ISA 320 teaches us to filter those risks and focus on what really matters, the items that could influence users' decisions. That's all for today. Allah Hafiz.